The atmosphere in Tehran's Grand Bazaar in early January 2026 reflects not celebration or closure, but uncertainty. Merchants, traders, and customers alike are navigating an economic environment shaped by persistent inflation, prolonged currency pressure, and limited market confidence. According to widely reported market indicators, the Iranian Rial has reached its weakest recorded exchange level against major foreign currencies, marking a significant moment in the country's modern economic history. By the second week of January 2026, exchange rates observed in informal market settings, often cited by economists as indicators of real purchasing power, placed the US dollar at approximately 1.47 million rials. The euro has been reported near 1.72 million rials, while the British pound has approached 1.94 million. These figures represent a continuation of a long-term depreciation trend rather than a single sudden event, reflecting structural challenges that have accumulated over many years. Economic analysts note that pressure on the national currency intensified throughout 2025. Estimates suggest that the rial lost a substantial portion of its value over the course of the year, driven by persistent inflation, reduced foreign currency inflows, and constrained access to international financial systems. By early January 2026, symbolic psychological thresholds in currency valuation were surpassed, further influencing public sentiment and market behavior. Observers point to a combination of external and internal factors contributing to the current conditions. International sanctions, reduced oil revenue, and limited access to foreign reserves have played a central role. These constraints were compounded by regional geopolitical developments in mid-2024, which resulted in heightened diplomatic isolation and further restrictions on trade and financial transactions. Multilateral institutions have since projected limited economic growth prospects, with some forecasting continued contraction into 2026. Inflation remains a key concern for households. Independent economic assessments suggest that annual inflation has exceeded 50%, with essential goods experiencing particularly sharp price increases. Food items such as grains, cooking oil, dairy products, and protein sources now account for a significantly larger share of household spending. As a result, consumer behavior has shifted, with many families prioritizing necessities and reducing discretionary purchases. In response to these pressures, the government has announced several policy adjustments aimed at stabilizing the economy. Among them is the planned currency redenomination scheduled to begin in March 2026, coinciding with the start of the new fiscal year. Under this proposal, 4 zeros will be removed from the national currency over a multi-year transition period. Officials have described the measure as an administrative reform designed to simplify accounting and financial transactions, while economists caution that such steps are typically effective only when accompanied by broader structural reforms. Market participants have reacted cautiously to the announcement. While some view the redenomination as a symbolic reset, others emphasize that long-term currency stability depends on controlling inflation, restoring investor confidence, and improving access to global markets. Retailers and wholesalers interviewed by regional media have expressed concern about short-term confusion during the transition, particularly regarding pricing and contracts. Parallel to formal economic activity, researchers have highlighted the continued growth of informal and alternative financial channels. Studies and investigative reports published over recent years indicate that digital assets, including stablecoins, have been used globally to facilitate cross-border transactions in sanctioned environments. Analysts note that while such mechanisms may offer liquidity for certain entities, they remain largely inaccessible to ordinary citizens and do not address broader economic imbalances. Public discourse surrounding economic conditions has intensified across academic, media, and policy circles. Universities, research institutes, and professional associations have hosted discussions examining the long-term implications of currency depreciation on employment, savings, and social mobility. These conversations reflect a broader effort to assess sustainable pathways forward rather than immediate political outcomes. Meanwhile, leadership changes within financial institutions have added another layer of uncertainty. The resignation of senior monetary officials in late 2025 prompted renewed debate about central bank independence, policy coordination, and transparency. Financial markets generally respond to such transitions with caution, particularly during periods of heightened volatility. As January 2026 progresses, currency markets continue to react primarily to expectations rather than short-term data releases. Economists emphasize that confidence, both domestic and international, will be a decisive factor in determining future trends. For now, the rial's valuation reflects a convergence of economic constraints, policy challenges, and external pressures accumulated over decades. For businesses and households alike, the focus remains on adaptation and risk management, whether through adjusted pricing, reduced consumption, or alternative savings strategies. Economic actors are responding pragmatically to conditions as they exist. Analysts agree that while the current phase represents a critical moment, long-term outcomes will depend on policy coherence, international engagement, and structural reform rather than short-term market movements alone.